Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice.
Welcome to the Stock Spinoff Investing Podcast. This podcast episode is going to be a little bit different from my first 8 that I've recorded, in that this is just going to be a solo episode. It's just going to be me and you, and I'm going to talk about one of the playbooks, one of my investing playbooks that I really like, and it's called the Dividend as a Catalyst playbook. So I'm going to walk through 2 examples of how I've used this in the past to make profitable investments. And then I'm going to talk about 2 current situations that have very good potential due to imminent dividend initiations. First, I just wanted to say a quick disclaimer. So I currently own Sunrise Communications and Havas NV, which are the 2 stocks that I'm going to be talking about. This is for informational purposes only, and I am not an investment advisor. Okay, so at a high level, let's talk about dividend as a catalyst and how I use this as a playbook. It's basically a pretty simple concept. And the whole idea is that spinoffs typically are sold indiscriminately when they're distributed to shareholders. And oftentimes, those spinoffs will languish for a long period of time unless there's a hard catalyst to force the spinoffs to re-rate. And dividend initiations can be that hard catalyst that forces the stock, the spinoff to go higher. And it's something that I always look at. Is a recent spinoff going to pay a dividend? Have they shared their plans to pay a dividend or return cash to shareholders in another way? And how meaningful is that dividend? Is it just going to be a token half a percent dividend or 1% dividend? Or is it going to be really juicy, in which case I think it might get investors excited? And basically, dividend initiations just force investors to pay attention. And as I'll walk through in 2 case studies, it can force the stock to move higher relatively quickly. Okay, so the first case study I want to talk about is a company called Kontoor Brands, which was a spinoff of VF Corp in 2019. And Kontoor Brands was really focused on manufacturing jeans. So they were a denim manufacturer. And it seemed like a pretty interesting, stable business. Jeans have been around for a very long time. They're going to be around for a very, very long time. And one thing that I just wanted to look for was, is Kontoor Brands going to be returning cash to shareholders? Are they going to be paying a dividend? And so what I do before any spinoff takes place is I look through the Form 10, which is the equivalent to an S1 for an IPO. If a company is going to go public, they file their financials. How have they done in the past? How do they expect to do in the future? And spinoffs all file this Form 10 information statement. That's what it's called. And they always share their dividend plans or their capital return plans. And so I looked through the Form 10 of Kontoor Brands, and what I found was that Kontoor Brands was very specific in terms of the dividend that they intended to pay. They didn't say, hey, we're going to return 50% of net income to shareholders. We're going to return 40% to 60%. That's what a lot of companies do. Kontoor Brands said, hey, we're going to pay a $2.24 dividend. And so I said, okay, that is really interesting because now we have the dividend that hasn't officially been announced, but we've gotten pretty good confirmation and pretty good insight into what this company's plans are. Let's see how low the stock price goes, and let's see if we can buy this thing at a very cheap valuation and at a very high dividend yield. So Kontoor Brands started trading in 2019 in May, and it sunk like a rock. And I actually bought a little bit early. I bought in around $29.50. At that point, the dividend yield was about 7.7%. And that looked really attractive to me because the only other apparel company that paid a dividend that was meaningful at all was Hanesbrand, and Hanesbrand paid a 3.8% dividend. So at $29 a share, Kontoor Brands was paying basically double the dividend that Hanesbrand paid, and I thought that was pretty interesting. Well, the stock went even lower. It bottomed around 23 or 24, and at that dividend, at that price, the implied dividend yield was almost 10%. So that was pretty exciting, pretty juicy. And so as we thought would happen, eventually Kontoor Brands reported earnings. So they reported their second quarter results in early August. And they reported good results, and they reported this very sizable dividend as had been previewed in the Form 10, and the shares jumped 14% that day. And then by the end of the year, they were up another 28%. And so it's kind of the classic example of the dividend as a catalyst playbook because number one, you had the indiscriminate selling pressure. And then we knew that a dividend was going to be initiated, and we knew it was going to be pretty sizable and that it would get investors' attention. And that's exactly what happened. So I really like this Kontoor Brands case study because it really shows the dividend as a catalyst playbook in a nutshell. Okay, let's talk about another example. This spinoff happened 2 years after Kontoor Brands, but Jackson Financial was spun off from Prudential PLC in September of 2021. And you really need two things for the dividend as the catalyst playbook to play out. The first thing, which we talked about with Kontoor Brands, was indiscriminate selling pressure. With Jackson Financial, I knew that we would have that. And the reason why I knew we would have that, actually, there were a couple of reasons, really. First, there's a massive difference between the market cap of Jackson Financial and its parent company, Prudential PLC. So I think Jackson Financial's market cap was under $2 billion at the time of the spinoff. Prudential PLC's was closer to $40 billion. So that's a very big difference. There was also an extreme distribution ratio, meaning that Prudential PLC shareholders would receive only one share of Jackson for every 40 shares of Prudential that they owned. So in other words, this would just be a drop in the bucket for typical Prudential PLC shareholders. And then the third key reason why I thought that there would be some indiscriminate selling pressure was because this was a UK company spinning off a US business. And so it's just an unnatural shareholder base. And so all these reasons contributed to Jackson Financial really selling off, as we'll talk about in a minute or two. Then the other big thing was that Jackson's dividend policy, again, was disclosed in its information statement, its Form 10. And at this point, we had to do a little bit of math or a little bit of reasoning in that Jackson said that it wanted to distribute $375 million of cash to shareholders through dividends and buybacks every year. And so what I did was I said, okay, let's assume half of that is dividend and half of that is buybacks. And that ended up being a little bit conservative, but that got me to implied annual dividend of $187.5 million. And then in 2021, in September, the stock started to trade. And as expected, it just sank like a rock. The stock got as low as $24.50. I actually was able to buy some stock around that price. That was pretty close to my entry price. And that worked out to about an 8.2% implied dividend at that point. Now, the dividend hadn't been formally announced at that point, but similar to Kontoor Brands, we waited a couple months until November when Jackson Financial reported their Q3 results. And as expected, they announced earnings. The earnings were good, and they announced their initial quarterly dividend, which was the $2 annual dividend, which we knew it would be. And the stock reacted incredibly well. The stock was up 11% that day, and then another 27% throughout the rest of the year. Again, the other important thing to look at is what are the peer companies. So the two companies that I looked at that are in the variable annuity space with Jackson Financial, one was EQH, and that had a 2.4% dividend yield. So obviously an 8% dividend yield is almost triple or more than triple what the EQH dividend yield was. And then Bright House Financial, BHF, did not pay a dividend. And so my thought was that this dividend was going to be very meaningful versus peers. And it was, the stock reacted very well. Current examples. So those past examples are all well and good, but what's available today in the market? I think there are actually two pretty interesting situations. They're both European companies. One is called Sunrise Communications. The next one is called Havas. So let's talk about Sunrise Communications first. So what is Sunrise? Sunrise was a recent spinoff from Liberty Global that took place in the fall of 2024. Sunrise is a telecom provider that is only focused on Switzerland. So it provides mobile, broadband, and TV coverage. It is the second largest telecom provider in Switzerland. This isn't a very big, or I should say, this isn't a very large market, but it's very stable. Sunrise is the number 2 player behind Swisscom. Sunrise generates about 3 billion Swiss francs of revenue and about 1 billion Swiss francs of EBITDA. So a dividend, most importantly, a dividend initiation is imminent. So Sunrise has announced that it intends to pay a 3.33 Swiss franc dividend. The big caveat here is that this hasn't been approved and it hasn't been formally press released because this dividend has to be approved by shareholders. Now, the shareholder meeting is going to take place on May 13th, and I think approval is a shoo-in, but we have to wait for that dividend to actually be announced until that shareholder approval gets secured on May 13th. The X date is going to be shortly after the annual meeting. It's going to be on, if it gets approved, it's going to be on the 16th, and then it's going to be payable on the 27th of May in 2025. So this is not that far from the time that I'm recording. I'm recording this in April of 2025. So in about a month, this company is going to be paying out a quite sizable dividend as I'll discuss further. Okay, so what kind of yield could we expect? So right now, Sunrise has an ADR that trades in the US. It trades at about $51.74. Sunrise has guided that they intend to pay a 3.33 Swiss franc dividend. Helpfully, the Swiss franc has been very strong versus the US dollar. And so the USD divided by Swiss franc exchange rate right now is 1.22. So the expected dividend in US dollars is a little bit over $4. That works out to a 7.8% dividend yield, which is very attractive. So Swisscom right now pays about a 4.2% dividend yield. So this is almost double where the closest competitor pays. And I think it's almost an 8% dividend yield. It's almost like a special dividend because Sunrise pays this dividend. They don't break it out into quarterly payments. They pay it all at once. And so I think once it's announced, I think it could be a nice positive catalyst for investors that want to receive a nice chunk of cash back, about an 8% yield. And I think it could be a key catalyst to drive shares higher. So I think Sunrise Communications is very attractive heading into this dividend announcement. Okay, the next current example that I think is pretty interesting is Havas NV. This was a recent spinoff from Vivendi. You've seen the indiscriminate selling pressure. This company came out close to 2 euros per share. It bottomed at about 1.15 euros per share. It's come back to about 1.35 euros per share, but it's down significantly from when it spun out for no real fundamental reasons. It's just, I would describe it as just selling pressure that is typical that you see from spinoffs. What exactly is Havas? Well, Havas it's an advertising agency. The good thing about Havas is that it has a lot of publicly traded peers, which makes it relatively easy to value. There's WPP, there's Omnicom, there's Publicis Group, and there's Interpublic. And all these companies trade at a premium to where Havas trades. Havas not only does advertising, but they do communications, they do marketing, they do everything from design, branding, content production for their clients. They do media planning, they do buying, programmatic advertising. A big focus for them is in the health space, in the pharma space. So about 22% of their revenue comes from pharma and healthcare. But other than that, they're pretty well diversified across sectors and across geographies. Okay, so first thing that really jumps off the page to me is that Havas is really cheap. So if you look at it versus its peers, it trades at 0.5 times revenue. Its peers trade at 1.1 times revenue. If you look at EV to EBIT, it trades at 4.1 times. Peers trade at 8.6 times. If you look at PE, Havas trades at 6.4 times, whereas peers trade at 8.2 times. And then on an expected dividend yield, Havas trades at about a 6% expected dividend, whereas peers trade at about 4.4% dividend yield. And then the other notable thing is that Havas has basically no debt. So they have a lot less debt than their competitors. And so really across the board, in terms of all the metrics, the valuation metrics, Havas looks very cheap. Okay, what about the dividend? Let's talk a little bit more about the dividend and why it potentially could drive shares higher. So Havas has already proposed that it is going to pay an 8 euro dividend. Again, this dividend is not going to be approved or it's not going to be paid until shareholders approve this. I think it's a given that shareholders are going to approve this return of capital, but that meeting is not going to take place until May 28th, 2025, and at which point the dividend will be approved and it will be paid out. It's going to be an 8%. It's going to be an annual dividend. So it's going to be about a 6% annual dividend. And I think investors are going to be very excited about that. And the fact that this stock is trading at such a big discount to peers. And then on top of that, it's also paying this nice chunky dividend, I think could be a nice potential to drive shares higher once that annual meeting takes place. The other big catalyst that I wanted to talk about is at this annual meeting on May 28th, Havas is also going to approve a share repurchase authorization to buy back up to 10% of shares outstanding. So not only are you going to get a 6% dividend yield, but you're also going to give the company permission to start buying back up to 10% of shares outstanding. So I think these two catalysts could be very meaningful and drive shares higher. And they are Sunrise and Havas are two of my favorite dividend as a catalyst ideas to play in the market right now. All right, that's really all I wanted to cover in this episode. I know this one was a little bit short and sweet, but let me know what you think. If you prefer me to interview other guests, or if you prefer this type of content where I go through some of the strategies that I use to evaluate and make money investing in spinoffs. All right, as always, thanks for listening and make sure to tune in to the next podcast episode.